All right, today we're going to break down some pretty concerning signs in the US economy. We're going to look at the hidden stresses, the potential dominoes that are all lined up to fall, and most importantly, what it could all mean for you.
So let's start with a question that might just hit a little close to home. We're about to dive into a part of the financial world you've probably never even heard of, but one that could be managing your retirement money as we speak.
Okay, so it's called the private credit market. You can think of it as a kind of shadow banking system. See, when you or I need a loan, we go to a normal, regulated bank. But these firms, they lend massive amounts of money with way less oversight. And get this, where do they get all that cash? From pension funds, insurance companies, and yep, everyday retirement accounts like 401ks.
And believe me, this thing has grown at an absolutely explosive rate. In just the last decade, it has ballooned from basically zero to a whopping $3 trillion industry. But now, that incredible growth is showing some serious signs of stress. And investors, well, they're getting nervous, and they're rushing to get their money out. And you don't have to look far to see the cracks. I mean, look at the big players. Blackstone just saw a record amount of withdrawals. Another company, Blue Owl, completely slammed the brakes on redemptions for one of its funds. Even BlackRock is starting to limit how much its investors can pull out. So what makes this system so fragile? It really all boils down to one single, incredibly important concept.
See, the whole problem is that this entire financial system is built on borrowed money, what we call leverage. And that makes everything incredibly interconnected and, frankly, super fragile. It's like a giant house of cards. A little wobble in one corner can bring the whole thing crashing down.
And if you want to understand the raw power of leverage, you only have to look back to 2008. I mean, it felt like the entire world was falling apart, right? But what's absolutely shocking, what most people don't realize, is that the whole global collapse was kicked off by just 4.5% of mortgages going bad. Think about that. That tiny fraction was enough to start a global domino effect.
Okay, let me break this down for you, because this is where leverage gets really wild. Imagine you buy a $500,000 house, and you put down 50 grand. Now let's say the value of that house drops by just 10%. That $50,000 drop completely wipes out your entire $50,000 investment. Your equity is gone. A small 10% dip in the asset causes a 100% loss for you. Now, just imagine that same effect, but across the entire economy.
But this stress in private credit, that's not the only crack that's starting to show. There are at least 3 major dominoes all lined up, and it starts with the risk that this one problem could spread.
So crack number one is this risk of contagion, the idea that this problem could spread like a virus. JP Morgan's CEO Jamie Dimon had a great way of putting it, warning that when you see one cockroach, there are probably more. The fear is that the problems we're seeing now are just the beginning.
All right, the second crack? It's all about the price of oil. If you look back through history, there's this really startling pattern. Almost every single major recession in modern U.S. history came right after a sharp spike in oil prices. From the 70s oil embargo all the way to the 2008 crisis, a surge in oil came first. And guess what? Oil is looking pretty volatile again.
But here's the thing. This time feels different. The Federal Reserve, they're basically trapped. Normally, if a recession is coming, the Fed cuts interest rates to juice the economy. But with oil prices so high, cutting rates could send inflation into orbit. So they have a choice. Save jobs and risk runaway inflation, or fight inflation and risk a massive recession. They can't do both. It's a classic checkmate.
And that brings us to the third major crack in the system, government spending. When you actually look at where your federal tax dollars go, the picture is, well, it's pretty startling. About 70 cents of every single dollar goes to entitlements like Social Security and Medicare. The other 30 cents, that just goes to paying the interest on the national debt. You add that up, that's 100%. Every single dollar of tax revenue is already spoken for.
So what does that mean? It means that everything else, our military, roads, schools, you name it, all of it is funded entirely by going deeper into debt. This puts the government in an incredibly vulnerable spot if, say, a recession hits and tax revenues suddenly plummet. So, okay, with all these massive problems stacking up, what on earth can the government even do? Well, this is where things get really interesting. There's this unconventional theory involving a very, very old asset. The US government holds a massive stockpile of gold, over 8,000 tons of it. But here's the absolutely wild part. On the official government books, that gold is valued at, get this, $42.22 an ounce. That price was set back in 1973, and they haven't touched it since. So, the theory goes like this. What if the Treasury just updated the price, revalued all that gold to what it's actually worth today? Just by doing that, with a simple stroke of a pen, they would instantly create over $1 trillion of assets on their balance sheet. No new taxes, no new borrowing, the value is just there.
And look, before you say that sounds crazy, this is not some brand new out there idea. The US has pulled this exact lever 3 times before in its history. FDR did it to fight the Great Depression. Nixon did it twice in the early 70s. Each time, it was an emergency move to fix the government's finances when all the other options looked grim.
But wait, there's another layer to this theory. And this part might be even more clever. What if they could use this new gold to fix that oil price problem we talked about? The idea is the US could offer to pay oil-producing nations in gold instead of dollars, giving them a rock-solid, stable asset in exchange for stable oil prices for everyone else. Okay, so let's pull all of this together. What does it all mean? Well, when you connect the dots, you see an economy that's showing some very clear signs of fragility, one that's built on a deeply interconnected system of massive leverage.
Here's the bottom line. We've seen how tiny cracks in a highly leveraged system can kick off a huge domino effect. Right now, there are several very large cracks starting to show. That means the government's options are getting pretty limited. But there might just be a surprising, old-school tool waiting in the wings.
And all of this leaves us with one final, pretty mind-bending question. In this modern world of digital money and hyper-complex finance, could the ultimate escape hatch, the thing that saves the day, really be hiding in a 5,000-year-old hunk of metal?